Thank you very much for coming up here so early for this event. My name is Qian. My name, even though not the same word, but has the exactly same pronunciation with the most important word in the word, money. So when we say Qian come to Australia in Chinese, that sounds very much like money come to Australia. That got to be a good sign, right? So certainly we had a very jumpy start of the year. For this Chinese New Year, it's a monkey year, so what can we say? When we look at the up and downs in the financial market, I'm pretty sure there are more questions than answers at this point. I see some investors are deeply concerned, some investors are frustrated, some are confused, and some of them actually just say, this is the nature of the market. As an economist, actually, I have a lot of questions too. That's the nature of the role, but my job here today is to help you find the answers amid all those short-term volatilities. So today, I'm going to make a case for calm, a case for looking past the sentiments, and a case for careful and solid examination of the fundamentals country by country and market by market. So let's see. There has been certainly a lot of volatilities ever since early this year. Now, when we look at the financial market, I'm pretty sure there's more sentimental factors rather than fundamental factors behind the recent market volatility. For example, ever since the summer of last year, the market was so concerned about hard landing in China. But in fact, we found the chance in the near term is rather low, especially with the policymakers starting to put the near-term growth stability as their top priority for this year. You know what happened? Just last night, they cut the reserve requirement ratio again, and they surprised the market. And there's also a lot of concern about the falling oil price, renewed fall in oil price, and the potential damage to the global economy. But on the contrary, we found that actually a supply-driven decline in the oil price is a net positive for the global economy. The World Bank research found that every 30% drop in oil price, if that is driven by supply, will lift up the global economy by 0.5 percentage point. So it cannot be a negative. And last but not least, there's a number of US economic indicators decelerating, showing weakness, and the market is pricing in a pretty high chance of a US recession for the next 12 months. Stock market is pricing in something around 30-35%. Credit market is pricing in something that's very close to 100%. But when we think about a recession, to have a recession, you should have some overheating before that. And to have a bubble burst, you should have a bubble first. Now, when we look at the US economy, for the last 5-6 years, the household and the financial industry, they have been all deleveraging. So they are not building up the bubble. So given that, our model actually shows the chance of a US recession is lower than the market was feared of. It's only about 20%, which is just a little bit higher than the historical average of 15%. This economy will get into a recession once every 5 or 6 years anyway. So when we think about what the market is thinking, and it seems there is a clear distinction between what the market is feared of and what the reality is. So when we look at the financial market, don't let the sentiment dictate your agenda. And let's take a step back. Let's take a step back to look at the fundamental and the big picture. Now, what is the big picture? The big picture is that in 2016 and also in coming years, we are in this great process of converging to an equilibrium characterized by 4 lows: low growth, low inflation, low interest rate, and low asset returns. Now, after the great financial crisis, many of us has been quite disappointed with the global economic growth. It has been weak, especially when we compare to what we had before the financial crisis. Now, the truth is that we may never go back to the old and good times because in the past, what we have enjoyed, the high growth, was artificially boosted up by the excessive credit expansion in the private sector. So in other words, households and corporate, they have borrowed more than what they should, and they keep leveraging up. But the leverage cannot go up forever, and there will be paybacks. There will be paybacks. That means when the deleveraging comes, it will weigh on the economic growth. In fact, it has already weighed on the global economic growth ever since the financial crisis, and it will continue to do so in coming years. Now, this process can be long because we know that the cycle of leverage is much, much longer than a business cycle. So in this new equilibrium, actually, the trend growth for a number of major economies will be lower. For example, US trend growth will be only 2% compared to what we have seen in the 90s and 2000, 3%. And China will probably just grow around 5 to 6% compared to what we have seen in the past of 10%. But our non-consensus view here is that we are not too bearish. We are not too upset about this new equilibrium. Yes, it's going to be lower, right? It's going to be lower because of a lower contribution from credit. And there's also a bunch of structural factors, demographics, weaker productivity growth. But this lower growth is also healthier. It's also healthier because it's unlevered, it's more balanced, and as a result, it's going to be more sustainable in the future. But we are not there yet. We are not there yet. We are still in the middle of this convergent process. And the major reason is because still a number of major countries in the world has not finished their deleveraging process, or some has barely started the deleveraging process yet. So we know that after the financial crisis, US household and financial industries has done significant deleveraging. But Europe is only halfway there. Europe is only halfway there, and many emerging markets, as you see, right, including China, has been continuing to leverage up. One of the key reasons is because of commodity supercycle, before the financial crisis. Another reason is after the financial crisis, there's significant capital flows coming into emerging market because of the ultra easy monetary policy in the US. So when we think about it, in the future, Fed is probably going to normalize the financial situation, and then China will continue to slow down, and that will weigh on the commodity prices. That will just show you how difficult and how challenging the overall environment will be for emerging market, especially that when emerging market start to deleverage, it's going to be much more painful for them because they will have to deleverage in a rising interest environment. As a result, in coming years, what we're going to see is that the growth gap between the developed market and emerging market will start to narrow. Now, that is a structural theme, which is a reversal of the past 15 years. So, because we are still in this kind of convergent process, we are not in a steady state yet. The whole convergent process will be associated with heightened uncertainty and rising volatility. The weak link of the global economy will include emerging market, global manufacturing activity, as well as global trade. And there will be growth scares, frequent growth scares down the road, either worrying about a recession of US economy, Europe, or Japan, or hard landing in China or some other emerging market may come out as a black sheep. So we will have to get used to this kind of uncertainty and volatility down the road. Now, this is a big picture, And I think the overall words, the words I would use to characterize a global economy in coming years would be frustratingly fragile. Not just about the economy, but also about the sentiment in the financial market. Now let's take a look at the major economies and let's see where the real risk is. The first one is, of course, the biggest economy in the world, the major source of uncertainty in the financial market, US. Now, when we look at the US economy, now by the end of last year, when we are starting to prepare the 2016 outlook, we were already more bearish about the US economy compared to the market consensus. We believe the trend growth of the US economy is only 3%. It's only 2%. The 3% we enjoyed before the financial crisis was because of the household borrowing. Now, if you only have a trend growth of 2%, that means the US economy actually has sustained above trend growth pace for 5 or 6 years after the financial crisis. Now, with the labor market in full employment, and also with the Fed, the financial condition is tightening, not because of the rising rates, but more because of the strengthening US dollar. It's very difficult for the US economy to sustain another year of above trend growth. So we are expecting the US economy to normalize to its 2% trend growth, and it's perfectly reasonable to see some economic indicators that will start to see some deceleration. For example, in the labor market, we have been used to over 200,000 non-farm payrolls every month. Now that is not sustainable. And with only 2% growth, we're probably only gonna see 150 per month down the road. So I think that's how we see the US economy. So don't panic. Don't panic when you are seeing, oh, the economic data was not as strong as what we have seen in the past 2 years. That doesn't mean there will be a free fall in the US economy. It simply means they are normalizing to this trend growth. But I think the most important question, of course, is about what does that mean for the Fed? Now, with the Fed actually started to lift up in December last year, the remaining questions are, one, at what pace will they continue this whole process? And two, at what level of interest rate will they stop? That is the terminal rate, which is the most important thing for long-term investors. So I know there's different opinions, different answers to those questions, but I think for all those different answers, it all comes down to two things. The first thing is about where do you see the trend growth of US economy? 3%, 2%, or 1%? And the second is that will Fed ever consider the global environment when they set their domestic policy? Now, you know our answer? We think the US economy is stabilizing around 2%. And we think the Fed will have to think about the impact of the strengthening US dollar and global volatility when they set the policy. So that gives us a dovish tightening cycle for this time. Yes, they will continue to tighten in our base scenario that the US economy continue to muddle through, which in our view is 80% of the chance, but they're gonna be extremely cautious, they're gonna be extremely prudent, and that makes them appear dovish, even in a tightening cycle. So for 2016, what we are seeing is that they're gonna probably hike 1 or 2 times this year, stop there then, take an extended pause, 6 months, 9 months, give them some time to evaluate the impact of the hikes on US economy. If the US economy continue to muddle through, nothing exciting, but still surviving, then they will probably take the interest rate to 2.5 to 3%, which is much lower than the historical average of 4.5%. But there is a lot of uncertainty associated with the whole process. Think about it. There will be 7 FOMC meetings remaining for this year, And the Fed said they are data dependent. So that means every data matters. Every data will make the market start to panic a little bit, either stronger than expected data or weaker than expected data. And plus, if the US economy really gets into a recession, which is 20% chance in our view, then the Fed may have to reverse what they have done, going back to zero and maybe another round of QE. So that's why I say, I think for 2016 and maybe also 2017 and 18, Fed will continue to be the major source of financial market uncertainty. But you know what? I think despite all those volatilities, our long-time hold view is that for long-term investors, actually, hiking is better than no hiking. The reason is that when the Fed keeps the cash rate at zero, that means the return to all risky assets will be lower. And to reach a certain return target, you will have to take a lot more risk. And the Fed hike actually imply and argue for higher nominal return for all of us in the longer term. So it's not a bad thing. It's a good thing. So this is about the US, and the next question is about China. I know that there's a lot of concern about China, especially for economies that has close relationship with China, such as Australia. Now, I think for China, we are looking for the economic growth to continue to moderate down to 6.5% this year from 6.9% last year. But you know what? I think the biggest risk in China for this year is not really about the economy itself, but instead is about the policy uncertainty. Now, to be fair, China's slowdown is not a new story, isn't it? It's not new at all. The economic growth has slowed from 14% in 2007 and down to 6% something in 7 years. We know this slowdown will be secular, will be structural. China has accumulated so much excess capacity in many industry sectors, housing sectors, and they need time to get rid of those excess capacity. And demographic cycle in China is a lot shorter than other countries because of the one-child policy. So the whole population gets younger faster, and they also get older faster. And also the productivity growth is going to be weaker as the catch-up effect for a typical emerging market is gradually fading. So by the end of 2020, we are expecting the economy, the potential growth of China come down to 5% or even lower. But I think the market is particularly concerned about China this time, not because of something seriously wrong about the economy, but it's because what the policymakers have done ever since the summer of last year. Because they seem to have made a number of policy mistakes in the stock market, in the currency, exchange rate. So I think that basically makes the policymakers losing their policy credibility, and the confidence of the market start to weaken. We know that Chinese policymakers are handling the most difficult and challenging task among all the countries in the world. On one hand, they want to keep the near-term growth stability, trying to avoid social unrest. On the other hand, they try to rebalance the economy, getting rid of those excess capacity, and find a new growth driver. Yet, at the same time, they need to keep the financial risk in control. We know that the leverage in China has been rising pretty fast, especially after the financial crisis. Now, the leverage as a percentage of GDP is around 220, 230%. And most of that leverage is concentrated in the corporate sector, especially those low-efficient, state-owned enterprises. So the risk is there. It's not an exaggeration if we say, oh, China is actually working on the eggshell. And it takes a lot of efforts, a lot of art for the Chinese policymaker to maintain this kind of subtle balance, among different things. So what they have done is really making people worried. Can you really handle the situation? And people worry about China not just because, China, you're going to hurt yourself. No, but instead it's really because what does that mean for the global economy? Now, the interesting thing is that when we think about the spillover effect of China, for any country that's going to affect the global world or financial market, there's basically two channels. One is the financial channel, financial contagion, and the other one actually is the standard international trade channel. Now, China, because of the isolated capital market, because of the capital control, so the spillover, the financial contagion, is rather limited. The main channel for Chinese economy to affect the rest of the world is really through the trade channel. Now, if we look at the Chinese economy, the slowdown of China is pretty much concentrated in certain sectors: mining, heavy industry manufacturing, and housing. All of those sectors are commodity intensive. Let me give you an example. Housing is probably the most important sector in China. It's about 10% of GDP, the housing investment. And we estimate that every 10% decline in housing investment will take off 2 percentage points of the headline GDP. And housing accounts for 40% of China's steel demand. Now, ever since 2007, housing investment actually declined from almost 40% down to minus 3% by the end of last year. So you can see the slowdown in those sectors will heavily weigh on the commodity demand, and then the impact on those commodity exporters will be particularly significant, such as Latin America, Canada, South Africa, and of course, Australia. So we estimate that, every 1 percentage point slowdown in China's GDP growth will probably take away, 0.2 to 0.3 percentage points of Australians' GDP growth. So it's very important to figure out, the slowdown in China is going to be a more controlled, more moderate one, or it's a free fall, because a free fall from 7% to minus 1% can easily push Australia into a recession. So people have legitimate reason to worry about China, and I don't complain the market for that. But my advice is that in the near term, I would say in the next 18 to 24 months, don't worry too much about the hard landing risk in China. Don't over-panic. It's not because China is great. It's not because China is going to suddenly, rebalance its economy overnight. No. But instead, it's because the policymaker actually has a very deep pocket of policy tools that they can cushion, offset the slowdown in the private sector, and they can save themselves if they make further mistakes down the road. Let me just give you an example. They have 3.2 trillion FX reserve. Let's just assume that the capital outflows continue at current pace and the FX reserve declines for 100 billion every month. They can still hold there for 20 months and with enough money to bail out major financial institutions in case something goes wrong. Reserve requirement ratio is still high. They just cut it yesterday. Interest rate is well above zero, and central bank balance sheet is very solid. So that's what I'm saying. For the near term, don't be overreacting to a hard landing risk in China. But yes, there is no denial that the risk is definitely rising. The risk is rising, so I would say in the medium term, beyond that horizon, be mindful of the financial risk. But in the longer term, I would say don't give up China yet. And be hopeful. Because when I look at China, I know that China as an emerging market still have abundant room to grow. The capital stock per capita is only comparable to India, despite all the infrastructural spendings, over the past 20 years. Urbanization rate is still low, right? So I would say in China, actually, as long as they can really push forward serious structural reforms, serious and painful structural reforms, and they can rebalance, and there is a good future for China. So that's what I want to say about China. Then Japan. Japan is interesting. It's really come into the spotlight recently because they are, becoming more innovative with the negative interest rate. It has been 3 years after the Abenomics. It certainly has done a lot of good things. The economy has rebounded above trend. Corporate profit growth is very solid. That's why the stock market rally. And we also see the economy is getting out of the deflationary mindset. But what Abenomics does not change is the private sector's outlook for Japan's future. What's the future for Japan? The trend growth, potential growth for this economy is only 0.4% and is continuing to decline. The economy is about 40% of time in recession. And the population of this country will be 40% lower by the end of the century. So the question for the corporates is that, yeah, we have make a lot of profit now, that's good. Let's park them into the cash and deposit. Then when we talk about investment for future, where is the future? Who are we going to invest for? So I think this is a typical example that monetary policy does not solve fundamental problems. Right? That's why Abenomics has 3 arrows: monetary, fiscal, and structural reforms. However, so far we have seen little progress on the structural reform side. So BOJ, I'm pretty sure that they will continue to ease. They will probably announce more QQE, and also they will probably announce a deeper negative interest rate. And that will help to support the economy and sentiments in the near term. But we are quite skeptical about whether that is the right approach to deal with the fundamental long-term issue. So Europe, when we look at Europe, actually, we look at it and we think this is very much like Japan 2 years ago. And this is very much like US, 4 or 5 years ago, when the central bank just started to push out the quantitative easing program. Currency weakened, and that lift up the sentiment and also financial market and also the economic growth. So relatively speaking, we are more bullish about Europe compared to the consensus. We think they still have like 3-4 years cyclical rebound and above trend growth. But I think beyond that, the same question comes back. What have you done regarding your long-term competitiveness? What have you done with your potential growth? So I think that is something we need to watch for. And in the very near term, I would say, for the European countries, the key risk actually lies on the political side. Election, in many countries, Brexit, right? And also refugee crisis. So that is something that we need to watch for Europe. So this is a global economy. Fed is going to tighten. BOJ and ECB, as well as China, will continue to ease. And the global economy, in our baseline scenario, will just continue to muddle through, even though not much upside. What does this mean for Australia? I heard that Australia is the luckiest country in the world. You have gone through 24, 25 years without the recession. That's great. For 2016 and coming years, we are expecting Australian economy to continue to rise about 2%, but the risk is clearly on the downside. One thing we just talked about is China. Australian exports has risen from 5% to 35% in just 1 decade, to China, which is closely associated with China's investment boom. Now, with China slowing, then you would expect this kind of commodity exports will come down. But I think the good news is that, number one, we do not see China get into a hard landing at this moment. And number two, I think the slowdown in China's story is not just about the slowdown in the absolute growth level, but instead it's really about the change of different sectors, right? So we do see that actually in China, service sector consumption has been holding up pretty well. And that actually will benefit the service industry and maybe the agriculture industry in Australia. And the second risk, I would say, comes from domestic side. Domestic side, the housing, I think there's a lot of people worrying about the housing. A potential cooling housing market could definitely weigh on the economic growth. So we did a reality check. We did a reality check. We look into the price. We look into the price to earning rental ratio. And we found that actually out of the major cities, that's Sydney, and to a lesser extent Melbourne, there is little sign of overheating elsewhere. So that means a sharp and national-wide fall in housing investment is unlikely. So if we put everything together, yes, the risk for Australian economy is on the downside. But as long as we are right about modeling through global economy, then Australia will remain lucky in 2016 and coming years. So this is how we talk about the global economy. We see the growth will remain low. The question is, what does that mean for the capital market? We have low growth. A lot of the country, emerging market, will remain below trend growth, right? So that means the output gap is going to be significant there, and that will generate deflationary pressure. So inflation is also going to be low. If your growth and inflation is low, then the central bank doesn't have to keep interest rate at a very high level. So you're going to have low interest rate. If you have low cash rate, then that means all the return for the risky asset will be lower. So that means we will also have low asset returns. So this is where we see the expectation for fixed income market for the next 10 years. The average return is only about 2 to 3%, which is significantly lower than the historical average. For the equity market, the situation is pretty much the similar. It will be centering around 6 to 9%, which is also lower than the historical average. So it seems to be a changing world. Everything is changing, but there is one thing that does not change. That is, the higher return always comes with higher risk. If we adjust for the lower inflation and lower rates, then the long-term outlook for global equity risk premium in real terms is still close to the historical average. So in this kind of environment, the ultimate question for any investor is that, to reach a certain return target as we have enjoyed in the past, are we willing to take more risk? If you look at the portfolio, right, let's compose a portfolio, build a portfolio here. If we have a balanced portfolio, 50-50, 50% equity, 50% income, we can achieve about 6%. That's a white bar in between, on average, 6%. But this is a whole distribution. Now let's say if we want to be more aggressive, we want to take more risk, and then we take more equity into our portfolio, we go 70-30, 70% equity. Yes, the median will go higher. We will achieve on average 7% of return. But you see, the whole distribution is a lot wider. That means you're going to be subject to much higher risk. So either you're going to take the risk, more risk, or another feasible solution is that let's be realistic. Accept the reality. This is a low return environment. Let's spend less and save more. So here is what we talk today about the global economy. We are converging to a new equilibrium characterized by four lows. Now you know the four lows. But because we're not there yet, we are still in this conversion process, and this conversion process will be characterized by frustratingly fragile economic growth and also sentiments. US Fed is going to be very prudent. They are going to be a dovish tightening process. A near-term hard landing is unlikely in China, but in the medium term, be mindful of the risk. In the longer term, remain hopeful. In Australia, risk remain tilted to the downside with the baseline scenario about 2%. So I think there is a very good chance that you're going to avoid another recession in coming years. Then the outlook for global bonds remains guarded. Global equity do not appear to be overvalued exactly because of the low rates environment. So this environment is very challenging for every one of us. It's going to be low return with high volatility. What shall we do? And I think my colleague Jeff will definitely tell you more in his presentation. Thank you.